This wasn't just a crash. It was a controlled demolition of trust, of lives, and of the illusion that anyone was actually watching the system. The 2008 financial crisis wasn't an accident. It was a slow-motion train wreck engineered over decades, built on greed, willful blindness, and a mountain of fake money disguised as innovation. When it finally collapsed, it didn't just take down Wall Street. It took homes, jobs, savings, and futures. But the most dangerous part, the people who caused it walked away richer. If you were an ordinary person in 2008, you were probably blindsided. One week, the headlines were about rising home prices. The next, banks were imploding. Pensions were evaporating. The stock market was in free fall. And suddenly, your government was handing out billions. Not to you, not to the workers who lost everything, but to the very institutions that caused the collapse in the first place. The 2008 financial meltdown is often explained in technical jargon: subprime lending, credit default swaps, securitization, systemic risk. But strip away the complexity, and it's just a very old story with a modern twist. A story of money and power, unchecked and unaccountable. Let's rewind. In the early 2000s, Wall Street had a problem. The tech bubble had burst. The economy was wobbly. And investment banks were hungry for the next big thing. That thing turned out to be real estate. Because in the United States, buying a house wasn't just the American dream, it was the American drug. And Wall Street figured out how to sell it at scale. Enter the mortgage-backed security. A simple idea. Take thousands of home loans, bundle them together, and sell them to investors as a single product. The pitch was seductive. Low risk, steady income, backed by real houses. Who wouldn't want that? But there was a catch. To keep feeding the machine, banks needed more and more loans. And when they ran out of creditworthy borrowers, they started lending to people who couldn't pay. Subprime loans, adjustable rates, no income verification. It didn't matter. Because the risk, they said, was diversified, spread out, handled. It wasn't. Behind the curtain, a second layer of bets was forming. Credit default swaps. These were essentially insurance policies on the mortgage bonds, allowing investors to bet on whether loans would fail. It created a bizarre situation where people were gambling not just on homes, but on failure itself. And the more failure looked likely, the more money they stood to make. At the heart of this system were the rating agencies, Moody's, S&P, Fitch, who were supposed to be the referees. But instead of warning the public, they rubber-stamped toxic assets with the A ratings. They were paid by the banks selling the products, creating a fatal conflict of interest. Everyone was making money, so no one asked hard questions. By 2005, the housing market was already overheating. Prices were rising far beyond wages. Construction was booming in ghost towns. People were flipping houses they hadn't even moved into. It looked like prosperity. It was a bubble. And then the defaults began. As adjustable rate mortgages reset to higher payments, homeowners started falling behind. Foreclosures surged. The value of mortgage-backed securities began to drop. And suddenly, all those bets, all those safe assets, were worth far less than anyone admitted. Lehman Brothers collapsed in September 2008. Bear Stearns had already been swallowed earlier that year. AIG, one of the world's largest insurers, was next. These weren't fringe players. These were pillars of the global financial system, and they were imploding. Behind the scenes, panic spread like wildfire. Banks stopped lending to each other. Liquidity froze. Stock markets crashed. People lost their homes, their jobs, their retirement. In 1 year, Americans lost over $19 trillion in household wealth. But here's the twist. The bailout wasn't for the people. It was for the system. The U.S. government, under both Republican and Democratic leadership, moved quickly to inject hundreds of billions into the banks. Through TARP, the Federal Reserve, and other emergency measures, trillions were made available to stabilize the system. But stabilize for who? Most Americans saw no relief. Unemployment soared. Foreclosures continued. Meanwhile, Wall Street executives gave themselves bonuses with the bailout money. The architects of the crash were not only spared, they were rewarded. This wasn't just a financial mistake, it was a moral one, a systemic betrayal, and it revealed a chilling truth. The financial system is not built to serve the public. It's built to protect itself. 15 years later, the dust has settled, but the core machinery is still running. Only now it's bigger, faster, and harder to control. In the years following the 2008 meltdown, central banks around the world turned to their most powerful tool: money creation, quantitative easing. A polite term for printing trillions out of thin air and pumping it into the financial system to stimulate lending, boost asset prices, and restore confidence. And it worked, if you owned assets. The stock market soared, housing rebounded, corporate profits exploded, but wages didn't. Inequality deepened. The rich got richer. And the fundamental imbalance between financial markets and real life only grew. Then came 2020, when the COVID-19 pandemic hit, Governments unleashed an even larger wave of stimulus, more money printed in 2 years than in the entire decade before. Zero interest rates, emergency lending, direct cash to consumers. And for a while, it felt like a new era, as if we'd finally figured out how to keep the system afloat forever. But of course we hadn't. In 2021, inflation roared back, not just in food or gas, but across the board. The very thing economists had dismissed as transitory became stubborn, persistent, and politically toxic. Central banks, once the heroes of the recovery, were now scrambling to undo their own excesses. Interest rates surged, markets fell, and debt became expensive again. And the old cracks, the ones that nearly broke the system in 2008, started showing once more. Except this time, the system is far more fragile. Corporate debt is at historic highs. Governments are deeper in the red than ever before. Consumers are addicted to credit. And the financial industry, now more concentrated and less transparent, has evolved new tools for risk, leverage, and illusion. Crypto markets rose and collapsed. Fintech firms promised innovation while quietly repackaging old traps. And yet, the core dynamics remain unchanged. A financial system designed around debt-fueled growth, policymakers afraid to let bad ideas fail, regulators captured or outgunned, and everyday people left to pick up the pieces when the cycle breaks again. So what can we learn from 2008? First, complexity is not safety. The more complex the system becomes, the harder it is to regulate, and the easier it is to hide risk. Wall Street thrives on opacity. The more you don't understand, the more they can sell you. Second, incentives matter. If bankers know they'll be bailed out, they'll take bigger risks. If regulators know their next job is at a hedge fund, they'll look the other way. And if politicians fear market crashes more than public anger, they'll protect the system, not the citizen. Third, financial education is survival. You don't need to be a Wall Street insider to protect yourself. But you do need to understand how the game is played. That means recognizing bubbles. That means questioning narratives. That means asking, every time you hear about a new financial product, a new boom, a new policy, who benefits? Who bears the risk? And what happens when the music stops? Because it always stops. The 2008 crash was not an anomaly. It was a preview, a warning. And if you look closely, the same architecture is still in place. Just more digitized, more automated, more fragile. And when the next shock comes, and it will, don't expect the cavalry. Expect a bailout, expect inflation, expect volatility, but don't expect justice. Not unless you understand what's actually happening behind the scenes. Real wealth isn't just money. It's knowledge, awareness, resilience. It's the ability to see the storm before it hits and know how to stand firm when it does. Because the system won't warn you. The headlines won't save you. But history will teach you. If you're willing to listen. History doesn't repeat. But if you don't understand it, it'll crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.